And here is a genius telling you, don't buy in the S&P 500. This is probably one of the most dumbest shit I ever heard in my life.
I think the biggest scam in our generation today is the S&P 500 index fund because most people don't realize that these are financial products that are packaged, marketed, and sold to people like you and me, the common public, by companies like Vanguard, BlackRock,
Yeah,
State
okay, what's
Street,
wrong
and
with
many
that?
others.
What is wrong with the S&P 500 being packaged by all these companies? Isn't that a good thing? Listen, investing in the S&P 500 is one of the best options that's out there, okay? Especially if you want to be heavily diversified. Coming out here saying S&P 500 is not good and because it's marketed by all these companies. Well, yeah. I mean, hello, of course it is. And let's be very honest, a lot of these companies don't just market that. They market a whole bunch of things. This guy's not done yet, man. I've seen this video and man, this guy is just, oh man. He's gonna say some stuff and the comment section is gonna blow up.
And these are marketed as safe long-term investments. And that's exactly why we get charged these expense fees, which is basically a price you're paying for the product. And that's why they're extremely profitable to these asset managers, which have trillions under management.
Okay, and what is wrong with that? So far, what is wrong with the fact of they're charging the expense fee? The expense fee is minimum. It is so small. It's like 0.01%. It's so minimum. Why? Because it's not an active portfolio, right? The S&P 500 is not something you need to go in there and tinker with so much. It is not active at all. It's extremely passive. And it's simple. You follow the top 500 companies in the S&P 500. That's it. I don't need to do day trading, when to buy, when not to buy. 500 of the best companies. But he's not done. Because you already know what he's going to say. Oh, because of all these other tech stocks, he's going to say some nonsense, and I got something for him.
But the one thing you got to realize is the S&P 500 is extremely top heavy, meaning that the top 7 to 10 companies make up 30 to 35% of the entire index itself. And these companies are the ones that are responsible for a majority of the index's movements each year. So the real question is, if 7 companies are generating a majority of the returns of the index, why are we then putting our money in the other 493?
I got it. I got it for you right now, my man. You see, first of all, what you're doing is you're heavily diversified. If those 7 companies, the textile companies, are so heavy, then guess what? I've been investing in the S&P 500 since probably 2000-ish, 2005-ish. I was a late bloomer. But like in 2000, I started investing. And I gained so much in my portfolio because of companies like NVIDIA, Tesla, like he mentioned. And now everyone is saying, oh, now it's top heavy. So you got to be very careful. But guess what? There was a time when I invested in S&P 500 where those 7 stocks were not the top heavy stocks. I bought them because I bought it within the S&P 500. I didn't buy it individually, and it blew up. My portfolio now is doing awesome, S&P 500, and these companies ended up from the bottom moving up to the top. That's awesome. So guess what? I didn't have to predict these companies and buy it, when it was first out in the market, thinking, speculating like these companies are going to blow up. No one knew. I invested in it. How? Because I invested in S&P 500. So I was able to enjoy the ride of those stocks. Now, hindsight 2020, of course, someone would say, man, I could have just bought those 7 stocks and forget the S&P 500. But we don't have all that information, and we don't have hindsight 2020 here. We have to go with what we have right now. And think of it this way. There could be 15 other stocks right now in the S&P 500. He's saying there's 493 other stocks. Yeah, there could be 15 of them or 11 of them within those 493 stocks that could be the ones in the future now on the top. And I'd rather be the one that have these top 7 take a dip and then these other 10 or 15 stocks or maybe 3 other stocks blow up. That's the whole point of diversification. The portfolio is moving, and within the past 40 years, guys, the S&P 500 had grew on average 7% after inflation. It's not bad, but this guy just wants to be on TikTok spewing nonsense. It's ridiculous. S&P 500 all day, every day. If you want to speculate on the side, go ahead, but make sure you have at least an index fund that follows S&P 500. That's all I'm saying.
So instead of buying the S&P 500 index, literally just buy the individual stocks of the top 7 holdings. You would literally get higher returns and remove all of the companies that are bringing down your portfolio. By doing this, you could see your returns double compared to the S&P.
There is no other companies that's bringing down your portfolio. Okay? There could be other companies that is not moving as much as the top 7 companies are not. But to say, you know what, just buy these other seven stocks, no, man. We don't know which the other stocks are. We all knew right now which stocks to buy because in 15, 20 years from now, it's going to freaking gain 20, no, not 20. I think S&P, I think NVIDIA blew up probably like 2,000, 3,000%. That's a lot. If we knew that, of course we will all pick it. But we don't know, right? We do not know. So what we'd rather do is buy 500 stocks, a piece of it, and grow with one of those stocks when they do blow up. That's what we truly want to do. We don't know. That's why the S&P 500 is awesome. And any companies that start failing and not doing that great, well, it gets pulled out, another one gets added in. It's going to diversify all the damn time if you follow that method. The S&P 500 works, guys, okay? We cannot just predict stocks and act like we know exactly which ones we're going to pick. I don't want to be a day trader. I don't want to be worried here saying, oh, now it's going down, buy another one. This one seems good. No, I'm not trying to do that. And if you want to build your own S&P 500, buy 500 stocks that you think are going to blow up, then go right ahead. But you're going to run into the same problem. He wants to put all his eggs into one basket, into winning stocks. It's a little too late now, right? It's extremely too late. Now it's on the high end. So what he wants to do is buy high and sell low, right? Which is the opposite of what they tell you when it comes to investing, which is, buy low, sell high. But he's acting like he has it figured out. You just buy the top 7 stocks right now that we all feel like is inflated. Right now, there's talks of being an AI bubble. And a lot of these tech-heavy stocks a lot of it is due to AI. And now he's telling you to buy those 7 stocks and neglecting the 593 others. This guy is something else.
Now, yes, is this riskier? Of course, it's riskier than buying the S&P. Obviously, when the market is down, you're going to see a higher loss in your portfolio, but your goal is not to sell here, right? If your goal is to hold long-term, those losses, theoretical losses, don't even matter. You're holding for the long-term anyways. Literally, when the market is down, just don't sell.
Well, yeah, I mean, it's that simple, right? The market is down, don't sell, but that's not the behavior of people when it comes to market. When you're seeing a stock just go down and crash, some people are going to freak out and they're going to sell. And you know what? I don't buy individual stocks, but if I was someone that owned individual stocks, I would sell because there is no guarantee those stocks are going to rebound. And that's the reason why I don't not buy individual stocks. For that reason, I know myself. I understand that I would just not be able to just sustain that downfall of a company for so long in the stock. I won't. So that's why I do an S&P 500 and I continue living my life. I buy the things I want to buy. I enjoy life. I spend money in the high-yield savings account for emergency fund. I put more money into the market, dollar cost averaging, and I continue to enjoy life rather than just worrying about individual stocks, which this guy thinks he has it all figured out. He has it all figured out.
And you might be thinking like, okay, what happens if the markets change or in 10 years there are new market leaders? It's currently very tech heavy and that might not be the case in the future. So when it does change in the future, just reallocate your portfolio to the new top 7 or 10 companies, whatever sector they may be, and you're good to go. But yeah, but those are just my 2 cents. I don't think you need the S&P 500. And if you want higher growth, then this is what I suggest.
What did you suggest? He didn't suggest anything. It even says right there, it's not financial advice. He didn't suggest anything. And what he's failing to recognize is you gotta be right twice. Okay, you gotta be right to know when to sell it, and you gotta be right to know when to buy it in order for this to work. And you cannot just do that once; you have to do it multiple times. And the S&P 500 will do that for you. Right? The S&P 500 will do exactly what he said. If things start turning in the future, well, then the S&P 500 is going to turn along with it. But you don't have to be the one to time it and stressing you out, trying to time it. I get it. Everyone on social media just wants to get some clicks. I do not think this is rage bait, but it's rage baity, right? It's rage baity to say like, don't buy the S&P 500 due to the fact of yada, yada, yada. Come on, right? You are entitled to your opinion. Personal finance is personal. You could do what you want to do with your money. If your risk tolerance is really high and you think you're some type of financial genius and you can predict when stocks are going to blow up, then by all means, go ahead. But right now, with the AI bubble being a conversation, investing in only 7 stocks, which means all you are doing is going 100% all in on tech stocks, might not be a good idea. Okay, might not be a good idea at all. And even with that being said, yes, I invest in S&P 500, but I also invest in small cap and I also invest in international, which technically a lot of these companies in S&P 500, yes, it's companies within the US, but they operate internationally as well. So you already get some exposure internationally with the S&P 500. But just buying 7 stocks and that's it, and you think like you're a genius in the future, you could just do it yourself. It's not good financial advice. What do you guys think about it? Drop a comment down below because I would love to hear it. At the same time, hit the like, leave a comment, and subscribe. Peace.